We're watching gold prices hitting a new all-time high, and our next guest says there are more gains ahead. Joining us now is Ben McMillan, IDX Advisors Chief Investment Officer. Ben, it's a perfect day to have you on. We did see gold rise to a fresh all-time high. Ben, is that Fed easing? Is that central bank buying? Is that geopolitical tensions running red hot? Is it all three, Ben?
It's all the above. And, the good news as it relates to gold investing is, gold's been very sleepy for many years. And all of a sudden, I think it's kind of hitting on all those cylinders that you just mentioned. And there's more and more articles about, gold being, kind of a, for lack of a better term, Goldilocks hedge against a lot of different things out there, not the least of which is, central bank buying among concerns about just, kind of global quantitative easing or fiscal deficits run amok.
Do you have to believe then in some kind of doomsday out there to believe in gold having legs? Do you have to believe in there being a potential recession or at a minimum a hard landing to see more growth for gold?
So that's an excellent question. The short answer is no. And, when you think about it, gold historically has been, like you said, kind of associated with, very risk off, very flight to safety type trades like, hard landing recessions. I think as we move forward, what we're seeing, and the central bank buying is the best example of this. And one of the reasons that, gold has had kind of a slow and steady, and surprising rise this entire year is that there's just very real concerns about not only the dollar as a global reserve currency and the United States simply just printing too many dollars. I mean, if you look at central bank buying, they're selling treasuries and buying gold. So they're opting for, the currency that is not the US dollar base. And that can only go one way going forward. So that's not even necessarily a hard landing or a doomsday scenario. I think that's just a stark reality of where we are as it relates to global monetary supply and surplus, and that's this powerful tailwind going forward.
Any line of sight, Ben, into how hedge funds are positioned right now?
Yeah, I mean, hedge funds view it, hedge funds, CTAs, they've been generally long gold, much of this year, and I would continue to expect that to increase. If you even look at the gold miners, which is the higher volatility end of the gold spectrum, historically, we're even as we talk to institutional investors, advisors, we're hearing more and more of them start to buy things like the GDX ETF, for example, in their portfolios. And so I think again, this is getting back to part of it is just gold is a good hedge for kind of a lot of different forward-looking scenarios. It's one that has a powerful tailwind as it relates to this kind of consistent central bank buying. And it's an asset class that everybody knows. It's easy to explain. It's not a complicated bet. So it makes sense in a lot of portfolios.
How should investors suss out the investing opportunities with gold, the precious metal itself, versus the miners, especially for investors who are maybe hearing us consistently talking about gold's all-time highs and feeling like they're maybe a little bit late to the party? What should they be thinking?
Yeah, I mean, the first thing is we always tell people, remember that, gold miners historically have been, higher volatility. Now, that's not necessarily the case this year. And I think that reflects, miners having, trading at kind of historical discounts relative to the price of gold. But going forward, as investors think about it, if you had to pick one, generally people would favor bullion, gold, the metal. We like to diversify. We think that's a good bet. Generally most investors would probably want to size gold miners a little bit smaller because they are riskier. But again, with that also comes, greater opportunity. And, the other thing to remember with gold miners is, there is idiosyncratic risk as it relates to the companies. Generally, we favor ETFs. You can get broad diversification across the basket of miners. But there's also operational leverage. And especially at these levels, when you look at kind of new discoveries in gold, that's really slowed down over the last few years. So now all of a sudden, these mines that are going concerns and have access to extract the yellow metal out of the earth, have a lot more operational leverage if gold continues to set new all-time highs.
So Ben, take out your crystal ball. 12 months from now, where would you expect gold to be trading at?
So let me put it this way. We like to think in terms of distribution of outcomes. I would be very surprised if gold hadn't set, all-time highs 12 months from now. I'd be surprised if it was trading below, $3,000 an ounce. I wouldn't be surprised if it would, hit 3,500. So again, I think we've got some powerful structural tailwinds in place for gold that aren't going to slow down anytime soon. Now, that doesn't mean it's going to be a straight line up and to the right. There's, going to be volatility. We've got a lot of, risks out there. Again, some of which actually favor gold. But I do think there's, like I said, there's a powerful tailwind for gold to continue setting all-time highs, and I wouldn't be surprised if it was mid 3000s this time next year.
Yeah, speaking of risk, I want to switch gears in the commodity space as we end here and talk a little bit about oil. You mentioned the weakness in China, and you sound kind of optimistic. You say inevitably it's going to come back. What makes you so sure?
Well, just frankly, because China, has to do something. When you look at China, it's been kind of a phenomenal story for being a centrally planned economy. I have to credit the CCP. They've done kind of a shockingly good job of managing growth up into this point. But at some point, dislocations have to happen. I mean, it's just a fact of centrally planned economies. Now, what that means is, and if you look over at China, I mean, they're facing some massive headwinds, not the least of which is demographics. Their one-child policy is really coming back to bite them now. If you look at their economy, most Chinese nationals, most of their savings is tied up in real estate, which has kind of been artificially propped up by their shadow banking community. So the unwind over there is very nasty. That that retrenchment of demand is what's been pulling back on commodities. So the reason we're bullish, not necessarily in the near term for oil, but again, kind of intermediate and longer term, is that China stimulus is they're going to have to stimulate, potentially even overstimulate, to just get demand back online. And when that happens, coupled with what we think is kind of a lack of a Mideast conflict premium, that supports higher oil prices. Like I said, in the intermediate and longer term, I do think kind of in the next quarter we could continue to see weakness, but longer term, even oil looks pretty good.
All right, Ben, we got to leave it there. Thank you so much for joining us. Really appreciate it.